Hi there. Welcome to The Open here on BNN Bloomberg. I'm Lindsay Biscaya in for Andrew Bell this week. So let's get to some of the stories we're following in the BNN Bloomberg newsroom. Brookfield and Quebec pension fund, the Caisse de Depot, are teaming up to buy Boralex in a deal valued at $9 billion. Boralex shareholders will receive just over $37 in cash per common share. That's an almost 32% premium. After the deal, Boralex will operate independently and plans to accelerate the execution of its 2030 strategic plan. The transaction is expected to close by the fourth quarter. AG Growth International beat estimates for sales in the fourth quarter. Meanwhile, the Winnipeg-based company also saw revenue grow in its commercial segment, primarily driven by international projects in Brazil, Europe, the Middle East, and Africa. The machinery company conducted a strategic review and restructured its executive leadership. AGI also announced the suspension of its quarterly cash dividend, effective immediately. And GameStop recorded lower revenue and profit for the fourth quarter. Sales of hardware, accessories, and software declined. The American company's stockpile of cryptocurrency also dropped in value. On the upside, though, revenue from collectibles rose 35% from the year before. In January, the company said it is planning a major acquisition of a public company to increase GameStop's value. And we'll take a look at the markets before the opening bell this morning. All trading up today. The Nasdaq up by more than a full percentage point as investors continue to weigh what's happening in the Middle East. The TSX, another interesting story. We're watching that closely today after seeing some losses last week, some gains this weekend. We'll continue to watch that today. Also watching the price of oil. It is falling as the U.S. ramps up its push to end the war in Iran, down currently by almost 5% to start the morning. The U.S. has reportedly drafted a 15-point plan to help bring the conflict to a close. So we'll wait for developments on that today in talks between the U.S. and Iran. But obviously, the price of oil already kind of reflecting what investors are feeling. And investors do appear to be cautiously optimistic this morning. Our next guest says the panic selling is largely done, and he has a bullish outlook for the S&P 500 and where it will land at the end of the year. Joining me now is Jim Thorne, Chief Market Strategist at Wellington Altus Private Wealth, and it's good to have you in studio. Thanks for coming.
Good morning.
I do want to talk about Iran and the U.S. and the price of oil, but obviously we've got that breaking news this morning of Boralex entering into a definitive agreement to be acquired by Brookfield and La Caisse. What are your thoughts on that?
Well, you have two very smart organizations taking a company private. You've got an environment in AI where cheap energy is the foundation of economic competitiveness. So I would suggest that Brookfield and the Caisse are taking the long view, seeing long-term value, and they're going for it.
I wonder if this aligns with like other trends we're seeing in the renewable energy sector, or maybe the start of some trends.
Yes, I think it'll be very interesting to see if they pivot the strategy, maybe go a little bit more traditional. How about going in, building some pipelines? You know, you never know, but I think energy infrastructure and whether it's storage, renewables, is going to be a major thematic play over the next 10 to 15 years. And, you know, I think Brookfield and Caisse are very, very smart, and they're long-term investors. And, you know, they probably have a very, long-term view of what they're going to do with this asset.
And just lastly, before we move on from this, is there concern, do you think, we're seeing another company potentially being delisted from the TSX?
I think Canada has to wake up and smell the coffee a little bit about, entrepreneurship and creating an environment to attract capital. So yes, I think, we're living in the past. Being someone who grew up in Toronto but worked in the States for over 2 decades, I think we really need to have a wake-up call up here. I'll leave it like that.
Okay, we'll leave it there because we've got so many other things to talk about today. Your outlook for the S&P 500 moving forward. I mean, you think maybe the panic selling is done in the meantime in terms of what investors are looking at over in the Middle East?
Yes, I think, I'm anchoring off of the 90s, right? When the CCP fell and the Berlin Wall fell, and what you had was a peace dividend where you had massive multiple expansion. And I think that's what we're going to have here. I think with the resolution of Iran, you're going to basically have a significant hit to state-sponsored terrorism. I think the terror premium in oil goes away. So you're going to have energy prices go down. You're going to have interest rate prices go down. And I think looking at the action in small cap and mid cap gold and silver names, there's still a lot of risk-taking in the markets. And I think that will manifest itself back into technology, which is right now trading at a massive discount on a historical basis to, let's say, energy.
You mentioned you think energy prices will go down. There's so much infrastructure, though, that was damaged or destroyed in the Middle East just over the last couple of weeks. Like, will that not take time to rebuild that and see those prices go down?
Yes, but we know that there's a shadow inventory. We also know that the Americans and the Israelis have been very careful not to hit major infrastructure within Iran. So I think this will pass. They will, rebuild. And I think we've got to get, and I don't know what price we're going to settle that out, but what does a world look like when there's no more, when you have Iran not controlling the Strait of Hormuz and you've got that terror premium go away? Is it $60, $65? Where is it, right? We'll find out. But the point I'm trying to make is, look, if you look forward, and you should be looking out 12 to 14 months, a peace dividend is coming. Trump is going to be successful. I think the interesting thing for me is, when are we in the markets going to stop treating Trump like a tail risk and realize that he does what he says he's going to do? Everything that he's doing in Iran was basically spelled out in his national security document released in the fourth quarter. So he's not into regime change. He's not a neocon. He wants to make sure that oil trades freely of a terror premium, and that choke points are not controlled by actors that are not friendly to the United States. What
do you make, though, right now, of the fact that Donald Trump and the U.S. say they're having negotiations with Iran? Iran says that's not happening.
I'm anchoring off of the tariff tantrum last year, when the same thing happened, but it was China and the United States were negotiating for tariffs. And Trump came out and said, we're negotiating. China said not. So I'm on the view that they are negotiating. There is going to be a deal cut. There is not going to be regime change. Oil is going to flow from the Strait of Hormuz. Maybe there'll be boots on the ground for a short period of time. But I think the president has made explicit that the Strait of Hormuz is not a concern for the United States as long as it's in the hand of folks that are friendly to the United States. So I don't think you're going to see a long-term presence of the United States within the Middle East.
Okay, so you think the panic selling is done. In terms of where investors should look for buying opportunities, you mentioned there's some tech stocks. Is there certain sectors that you think there are buying opportunities in right now?
Sure. What I do is, it's funny. There's an old saying that the narrative of the market follows price. So you look at charts that are really strong and are bouncing off, and I use the 200-day exponential moving average. So if you look at Goldman Sachs, if you look at Morgan Stanley, they bounced right off the 200-day moving average. If you look at the S&P 500 and the NASDAQ, they did the same thing. I'm of the view that the United States is going to rebuild. So this is Trump in a productive capital and rebuilding. So you're going to have a super cycle in CapEx, 100% tax deduction until 2031. So I like cat, deer, anything that rebuilds America. And then I think you're going to get deregulation in financials. The Clarity Act is going to put a tailwind to crypto, just like the Telecommunications Act in the 1990s gave a tailwind to building out the internet. So I like AI. And, yes, copper, sure. But I think in gold and silver and energy, those folks that are investing in those sectors, as Trump is going to fail and oil's going to 300, those folks have to get out and then basically have the long-term investors go in. And I think you're starting to see that in gold and silver. Been a bull in gold and silver for a long time, but we've had a generational run. It needs to rest, and I think oil's going to pull back, and so you're going to get that churn in the market. So I'm still very, very, very bullish, and it's going to be very interesting to see what happens when the narrative is happy days are here again, because the Iran regime is no longer creating havoc within the Middle East.
So you mentioned some of the stocks you like, Caterpillar, Deere. You also like GE Vernova. Yes. You want to talk about that one? What do you like?
Well, that's basically, it's just taking natural gas and turning it into electricity. Right. So The interesting thing is, if you look at AI, what it's doing, if you go back to the French Revolution, right? What did the French Revolution do? It made mathematics the key equalizer. Well, guess what? AI replaces mathematics. So all those smart guys in our math class who, went to Waterloo, they're done. They're innovated away. What is the key? The key is going to be cheap energy, one, and generalists, two. And so what GE Verona does is, in the short term, it makes turbines that converts natural gas into electricity. Love nuclear, but it's going to take a long time. That's a long cycle. So GE Verona, like Schneider Electric, Siemens, anything that you converts gets us electricity is really, really good. And it's a long-term theme. The stock hasn't pulled back at all.
Okay, we're out of time, but appreciate you coming in studio. Thanks so much.
Thank you.
That is Jim Thorne, Chief Market Strategist at Wellington Altus Private Wealth. Coming up, Air Canada's CEO is coming under fire for an English-only video and is being called to Ottawa to appear before the Official Languages Committee. We've got more on that right after the break. Stay with us. Following their first full day of examination into the crash of Air Canada Express Flight 8646 in New York, NTSB officials revealed the fire truck involved in that crash didn't have a transponder to trigger a warning system. For more, we are joined now by CTV's Scott Hurst. So, Scott, good morning. These new details emerging about that deadly crash between the Air Canada plane and the fire truck. Give us the latest in terms of what we know here about this signal that truck was missing.
Lindsay, good morning. First and foremost, runway 4 at LaGuardia remains closed. The on-site investigation continues at the airport. Bottom line, investigators are trying to determine which of the airport's many layers of safety precautions broke down or failed in this instance. As the investigators have pointed out, they say many times they often find not just one failure, but multiple, as the U.S. NTSB, the National Transportation Safety Board, is the lead agency. However, investigators from Canada are also involved, and we're learning there are new signs the disaster could have been prevented. Firstly, a ground radar system never issued an alert. The U.S. Port Authority fire truck that collided with the Air Canada passenger plane didn't have a transponder, a tracking device on board that should have alerted the airport's surface detection system. Also, there were at least 10 calls to stop in the final seconds before the terrible tragedy that went unanswered, as investigators have begun to lay out a preliminary timeline in the seconds before impact, saying just 9 seconds before the collision, the tower immediately told the truck to stop. But that happened just 1 second before the plane's landing gear touched down. Now, this is all part of the preliminary investigation. Analysis of the flight data recorder is underway, and a full transcript of the cockpit voice recorder, Lindsay, is expected to be released later today, potentially providing more insight into those final important few seconds.
So tragic. And meanwhile, there's like this kind of side spin-off story happening in terms of this crash, and that's Air Canada's CEO, who is coming under fire for his English-only message of condolence to the families of the pilots. That video message was released on Monday, one of the pilots actually from Quebec. So what can you tell us about the kind of scrutiny that this CEO is coming under?
And Lindsay, the flight also originating from Quebec, as well as the CEO and Air Canada ultimately under fire for what was not said as part of this message, a 4-minute message of condolence, mostly in English, almost all in English, except for 2 words, bonjour at the beginning and merci at the end. As you mentioned, the crash, we know, killed both pilots, one from Quebec. Now, in the video, which was posted on multiple social media platforms, the CEO, Michael Rousseau, refers to this as a very dark day for the airline and says he's deeply saddened by the deaths of the 2 pilots. But the Committee on Foreign Languages is outraged, saying Rousseau must appear before them by May 1st to explain why there wasn't also a French-only version. Now, in a statement to CTV News, Air Canada says Rousseau's ability to express himself in French does not allow him to convey such a sensitive message in that language as he would wish, and therefore, as it continues to say, Air Canada used subtitles to ensure that everyone can receive his message directly. However, this overall response and the lack of French response has left many people in Ottawa outraged, and as I mentioned, the CEO must appear before the Committee on Official Languages by May 1st. Lindsay?
So much to follow here. Okay, that is Scott Hurst from CTV News joining us live this morning. Scott, thanks so much for that. Appreciate it.
Thanks, Lindsay.
And up next, we will turn our attention back to Iran, the Iran war, as the country repeatedly states it has not talked to the U.S. President Donald Trump and says that he is doing this to influence the oil markets. We've got more on that right after the break. Stay with us. Welcome back to the latest now on the war with Iran. President Donald Trump says he is confident Iran is ready to make a deal to end the war, sending them a 15-point plan to end the conflict, while the Pentagon prepares to send more troops to the region. ABC's Rachel Scott has more in this report.
This morning, the Pentagon is preparing to deploy up to 1,500 paratroopers to the Middle East as the president weighs diplomacy. Sources tell ABC News the Trump administration sent a 15-point plan to Iran to end the war. And this morning, Pakistan says they have delivered the proposal. President Trump alluding to the plan just days ago, claiming Iran had already signed on.
Can you give us a
Many, like 15 points. 15 points.
Iran has said yes.
Well, they're not going to have a nuclear weapon. That's number one. That's number 1, 2, and 3. They will never have a nuclear weapon.
They said yes to that?
They've agreed to that.
Iran still insists negotiations are not taking place and claims Trump's statements saying otherwise are parts of efforts to reduce energy prices and buy time for the implementation of his military plans. Still, the president is adamant negotiations are underway, though he won't say who the U.S. is speaking to. He cryptically told reporters he knows Iran is going to make a deal because they gave the U.S. what he called a very big present, without saying what it is.
I'm not going to tell you what that present is, but it was a very significant prize, and they gave it to us.
Rachel Scott, ABC News, Washington.
Yesterday on Market Call, we were joined by Martin Cobb, Senior Vice President of Equities at Lawrence Steinberg Wealth Management. His focus was global and North American equities, and these were his top picks: Microsoft, Canadian Apartment Properties REIT, and Experian. And joining us today on Market Call is Brendan Caldwell. He's President, CEO, and CIO of Caldwell Investment Management, and his focus is North American large caps. Canadian small businesses are calling out, saying they are feeling the effects of labor shortages in Canada, specifically in the service industry sector. CTV's Alison Bamford filed this report.
Christina Bone's cleaning business started in her basement about 8 years ago. Back then, she says hiring was a little easier.
I was hoping to have about 10 people within 2 years, and I did that in 6 months.
The Southeast Saskatchewan business, based in Estevan, has grown every year since. Bone is in the middle of opening up a new laundromat, but says she needs to hire 10 more employees to keep up with demand.
We're starved for people, and to grow in a service industry, you need that person. You can't just sell more product. You need someone to go out and do the work.
She turned to temporary foreign workers a few years ago to help fill the labor gap. But Bone could now lose 2 of her cleaning staff in November, with more than 1.3 million temporary foreign work permits set to expire in the country by the end of the year.
For businesses, that means that they will have to replace those workers and retrain somebody and look to hire somebody. And so the hit to their productivity will be massive.
In 2024, Ottawa placed a 10% cap on the number of low-wage temporary foreign workers a company can hire. The cap will increase to 15% next month for rural employers, but provinces and territories have to opt in. The new measures would translate to about 2 positions here at the Crossroads Inn.
I don't know how they expect us to survive on that.
Hiring Canadians is still the priority for the businesses we spoke to, but they say it can be hard to attract applicants in their line of work.
And because this is a small town in rural Saskatchewan, it's harder than anywhere else.
Added stress that they say could be saved by drawing from a larger pool of workers. Alison Bamford, CTV News, Saskatoon.
Okay, let's take a look at the U.S. futures as we count down to the opening bells just a few moments away now. U.S. futures seem to be up at the moment. The Dow and the Nasdaq up by 0.9%, so almost a full percentage point. S&P 500 not far behind. Investors are weighing what's happening in the Middle East, hearing about this 15-point peace proposal from the U.S. seems to be fanning optimism. We'll take a look at the TSX as well, hoping potentially to see more gains today after seeing a couple over the last couple of days. So we'll be watching for that once the opening bells ring in just about 5 minutes from now, 6 minutes from now, really. We're watching the price of oil as well, obviously. It's been a big contender over the last couple of weeks, and it's falling today. It's down by more than 5% at the moment as the U.S. ramps up its push to end this war with Iran. As I just mentioned, that 15-point plan reportedly being drafted to help bring this conflict to a close. And so we'll wait to see how that really affects the markets throughout the day. We're kind of seeing a back and forth here in terms of what we're hearing from both sides. We'll take a look at the price of gold as well, extending gains on the news of that 15-point plan, despite Iran signaling little willingness to compromise. And we also heard yesterday, of course, that the U.S. is planning to send in more troops to the Middle East. So we're going to have to wait and see how that really plays out. But gold is just over 4,500 right now, slipping well below that 5,000 mark that it hit earlier this year. The loonie dropping today as investors weigh that ongoing escalations and de-escalations in the Middle East. It seems to be flip-flopping against its counterpart, down by 0.1% at the moment. And Bitcoin has been slipping. It was slipping at least below 70,000 earlier today. It seems to be trending back up at the moment. We're going to be watching a couple of stocks today. ARM Holdings could be a stock to watch after the semiconductor designer said it'll start selling its own chips for the first time. The new business is expected to generate about $15 billion annually within 5 years. It is indicating a 12% jump at the market open today, and we'll watch for that, of course. And General Motors is higher after Wolfe Research raised its rating to outperform, saying investors may be underestimating several tailwinds, including a lower net tariff burden. GM up by over a percentage point right now. Again, just some of the stocks that we're going to be watching today after the bells open. And that, of course, is coming up next. So stay with us. We'll be right back. Here are the opening bells at the NASDAQ. Constructive Partnerships Unlimited is ringing the opening bell. At the New York Stock Exchange, Invest America rings the opening bell. And at the TSX, Longpoint ETFs and Trading Central is opening the market today. It's time now for the first 15. We're going to take a look at some stocks to watch today. KB home price target lowered to $63 from $71 at UBS. And UBS analyst John Lovallo lowered that firm's price target on KB Home to $63. That's lowered from $71 and keeps a buy rating on the shares. That firm reset its estimates and price target following the Q1 earnings report. This is BNN Bloomberg. Trading day is just getting underway. We'll check in on the equity market now. We'll take a look at the markets now that they're open. We're watching the TSX today, of course, to see whether it makes any gains after a bit of a rough time. So far, so good, up by 1.4% for the TSX. The S&P 500 trading up as well. The NASDAQ up by more than a full percentage point. And for some movers south of the border now, we are joined by Bloomberg's Janine Panzer. So, Janine, good morning. It's good to see you. There you are. Okay, so we're going to start with Merck & Co. This company is buying Terns Pharmaceuticals for $53 a share in cash. Is that right? Tell us more.
Yes, so big news today for Terns Pharmaceutical this morning. It's in the deal with Merck. Merck is acquiring it for $6.7 billion deals. It will pay $53 per share. Roughly, this is about one-time charge for Merck & Co. too. The acquisition gives Merck access to a new leukemia treatment Turn's lead drug has shown promising early results in patients who didn't respond to initial treatment. So Merck needs that pipeline. It is bracing as market's been watching for its top cancer drug, Keytruda's patent expiration around 2029. It is one of the world's best-selling drugs. It's so important. It makes up nearly half of Merck's revenue, Merck sales last year as well. So it's been actively bulking up, striking a series of billion-dollar M&A deals like the one with Cidara and Verona. So what we're seeing here is Merck trying to stay one step ahead of that Keytruda patent cliff. So we'll keep a close watch on this.
Also keeping a close watch on ARM Holdings, this company gaining as it has plans to sell its own chips. Tell us more.
Yes, it's a major shift for ARM because previously, as we know, it's just licensed, it's designs to companies like NVIDIA and Apple, but now it's moving to actually making its own chip with Meta as its first big customer. So the company say that this new business could generate about $15 billion in annual revenue within 5 years and could eventually overtake its current licensing business. So this is huge for ARM. The chips will be used in data center for AI workloads, an area where spending is surging. So this is ARM moving up the value chain and potentially competing with its own customer, actually, as it looked to capture more of that AI-driven demand.
Okay, Bloomberg's Janine Panzer joining us live. Janine, thanks so much for that. Appreciate it. Coming up, we will check in on the markets and get some fresh perspective on investor sentiments. Stay with us. Mediators from Turkey, Egypt, and Pakistan are pushing for a meeting between the U.S. and Iranian officials, even though the two sides appear to be far apart. It's giving investors optimism about the markets. Let's get some perspective from Andrew Pyle, Senior Investment Advisor and Senior Portfolio Manager at CIBC Wood Gundy. Andrew, it's good to have you join us. Thanks so much.
Good morning, Lindsay. Great to be here.
I'm wondering what you make of how the markets are reacting to this news, because there doesn't seem to be any clear sentiment from either side. We're hearing different things still from the U.S. and from Iran, but it seems as though investors are a little more optimistic today.
Well, they're definitely more optimistic. Anything that suggests that this war can be resolved somewhat quickly is going to give the markets cause for relief, Lindsay. And I would say right now, the news has been trickling out. I mean, investors would love to hear press releases from all sides saying this meeting is in place, this is going to happen. That hasn't been the case. We've heard, obviously leaks coming out of the U.S. We've heard refusals or denials by the Iranians. And of course, now we have the Reuters story that is giving the market the lift. But as we look at this market, this is a market that's not going to soar out of the gates today because there's still so many unanswered questions as to what this meeting entails, what deal is on the table, if any, and what is happening with the troops that are being sent en route as we speak to the region.
That's what I was going to ask you, right? Like, there's still so much to sort through here. This probably isn't going to be a quick process, so I'm sure we can expect more volatility in the markets, at least in the short term.
Yeah, I would definitely prepare for more volatility. This whole situation remains fluid. Again, fingers crossed that we do get resolution of some type that basically, at least for now, ceases hostilities. And I think from a market point of view, we got to bring it back to the fundamentals. And the fundamental fear is really the supply constraints that has emanated from this conflict through the Strait. And I think even if that were to be resolved, this market would have some legs to go. But right now, I say it's too premature.
When we're looking at economies around the world, given everything that's been happening, the latest flash S&P Global PMI numbers show some fading momentum in the U.S., Europe, and Japan. Do you think we're looking at now a higher probability of a recession?
Well, the probabilities are definitely higher from whatever they were before this conflict, Lindsay. Some economists had those probabilities quite low for this year, but I would say that was also predicated on employment conditions that were relatively stable and a path to lower interest rates in the States and around the world, which again, in the last 2 weeks, has been turned on its ear. This conflict has really taken those risks of or probability of a recession and elevate them. So I think you have to be cognizant of that. And again, a lot will come down to whether we can resolve this situation. If we can, Oil prices will continue to move lower. It's not going to say the damage hasn't already been done, but the damage may be contained to the point that we do not get an actual recession. And that's something that would give some more relief to the markets.
We're also seeing bonds falling sharply during the course of this conflict so far. And we're hearing that comparison a lot about 2022, that this is similar to kind of the COVID years coming out of COVID. Is that a fair comparison, or is it different now?
I think it's different, Lindsay. I think, back then we had a situation where central bankers were behind the curve on getting control of inflation. Inflation was obviously much more rampant than what we have today. Yes, we have a supply shock that in some respects is more significant than Russia-Ukraine. But I think right now what we're looking at, or what we're concerned about, to your earlier question, what are the odds of a recession globally or even in the States, is that demand destruction possibility. And if that were to happen, I would argue that rates are probably have overshot to the upside, because at some point those rates would have to come lower. Central banks would have to respond to a weaker economy. Again, it's too early to tell what direction we're going to be going in. We'll have to see where these meetings go, if anywhere. But right now, I think the damage to the bond market is overdone relative to the stock market. And I think that's where you might see a bit of a pickup.
So given that right now, does it maybe make sense for investors to avoid longer duration bonds at the moment?
Yeah, that story remains the same, Lindsay. The reason why we've been avoiding long-term debt is because of the fiscal concerns emanating out of the States and globally as countries ramp up spending, and we face the prospects of weaker economic growth, which means weaker tax revenue growth. So that hasn't been alleviated. We're still looking at a situation in the States that is tenable. And we think the fiscal risks in the States have not been fully appreciated at the long end of the curve. So we're avoiding that section of the market. We do like short-term credit right now. We do like short-term investment grade credit. And I think that's where you could see a bounce back.
What about the recent move in yields that we've been seeing? Is this simply like a near-term inflation adjustment, or is this kind of a more because of the conflict we're seeing coming out of the Middle East?
I think partly it's a near-term inflation adjustment, Lindsay, but it's also an uncertainty, and it's a risk premium adjustment in the curve, as we're seeing in so many other asset classes around the world, because investors simply don't know. And whenever we have high degrees of uncertainty, that uncertainty has to be priced into the market to some respect. In the case of the bond market, it means that we get higher credit spreads. It means we get higher yields. In the case of equities, obviously, we get depression in stock valuations. And until this uncertainty lifts one way or the other, those risk premiums are going to remain elevated.
What are you telling investors to do right now amid all of this then? Like, is there certain areas people should be staying away from, certain kind of more safer places for investors to be?
Well, safer is a relative term right now. We have been, over the last 18 months, slowly pulling away from the U.S. market, moving more money into Canada and Europe and Asia. That strategy still remains valid, in my opinion, because this is just one event of many that we've seen coming out of the States that I think ultimately is not doing great service for the U.S. economy. The message to investors is really to just stand pat for now and evaluate the situation as we move through it. Do not make any erratic judgments or erratic moves until we have a clear desk of information as to what is going to happen over the next couple of months.
Another interesting story is what we're seeing when it comes to the price of metals right now, particularly gold, even copper as well. What do you make of what we're seeing? And do you like gold right now, or are you kind of staying away from that at the moment?
No, we still like gold, and I think this pullback in gold might give us a bit of more of an opportunity to add to that position. Gold is a valid investment in times of chaos, and a lot of investors have been scratching their heads. Well, why isn't gold moving higher, given that we have a fairly large war taking place in the Middle East? And I think part of the answer to that is that investors have taken losses in other segments of the portfolio, and gold has been that place where we can cover those losses. I think if we look forward, the fiscal concerns remain. We still believe that the U.S. dollar structurally is probably going to see a weakening pattern. That should be good for gold. And again, if we think that uncertainty in the world is going to be evaporating in the next couple of weeks, I think that's a pretty naive assumption.
Right. And because you say here the materials group has been the worst performer in Canada and elsewhere this month, it's been so interesting to see how that's been affecting the TSX as a whole throughout this conflict, too.
Well, exactly. If you take a look at the month as a whole, I mean, Canada has underperformed, where we're still outperforming the S&P 500 year to date. And we expect that outperformance to continue over the course of 2026. But you're absolutely right, Lindsay. Materials have been the major drag on the TSX. And I think that's a drag that will be alleviated as we start to see gold starting to get some footing here. And also keep in mind that we're still looking at infrastructure building. We're still looking at data center building, which is going to improve demand for copper, where we think we could ultimately see some shortages. So metals in general, I think, are probably overdone right now. But we'll have to see what the next few weeks bring us.
And just lastly, before I wrap things up, like given everything we're seeing right now, I know it's so hard to predict the future. There's so much volatility, so much uncertainty. But in terms of future rate cuts, rate hikes, what do you think the Bank of Canada, we'll stay with the Bank of Canada for now rather than other central banks. What do you think is going to happen?
Well, we're going to take Governor Tiff Macklem at his word that had we not had this event in the Middle East, we might have actually been looking at lower rates. I think that line of thinking is still in place at the Bank of Canada. If we can get resolution to this, if we don't see a risk of elevated inflation expectations, if oil moves lower, and we still see weakened conditions domestically, I think the path is still there for the Bank of Canada to cut rates 1 or 2 times. But until we get more information, Lindsay, the bank is going to be as clueless as to you and I as to where this is going to take us.
For sure. Okay. Andrew Pyle, Senior Investment Advisor and Senior Portfolio Manager at CIBC Wood Gundy. Thanks so much for joining us today. Appreciate it.
Thanks, Lindsay. Pleasure.
Just ahead, Manitoba has unveiled its budget yesterday, which included a cut to the provincial sales tax on food. We'll dive into that right after the break. In the release of its budget Tuesday, the government of Manitoba unveiled a cut to the provincial sales tax on food as affordability continues to be a point of contention for Canadians. For more now, we're joined by CTV's Rachel Aiello to break down exactly what this means. So, Rachel, how effective is this policy when it comes to actually addressing affordability concerns?
Yeah, good morning. Well, I think that is a question that kind of remains to be seen. Obviously, what's been committed here is likely going to be a politically popular move. What the economics of this is, I think, may be another question. So what we're talking about here is the relief of the PST, which is at 7% in the province of Manitoba, off of all grocery items. Now, worth remembering, of course, some grocery items are already tax exempt, but this would remove the PST from everything from prenatals to pre-cooked chicken. This is something that Premier Wabkanu has indicated is going to help Manitobans at the cash. But I think the question around how effective this will be broadly when we're talking economics is because this announcement is coming right alongside the Manitoba government announcing that their federal or their provincial deficit is $498 million. So this initiative, this PST removal, is going to cost the province another $32 million. Of course, they're saying this is going to save Manitobans that $32 million. So certainly this is a move looking to ease some affordability concerns, but obviously coming alongside quite a big deficit.
No kidding. So if the Manitoba government is moving to make life more affordable in this way, or at least attempting to, what example does this policy set for how the federal government can address affordability for all Canadians?
Yeah, so certainly this is an example that the Premier is indicating other provinces should get on board with. So it is possible that across the country there could be a sentiment of picking up a similar idea. Federally, though, I was looking at this commitment yesterday and thinking it feels like I've seen this before. And that's because earlier this fall, the federal government announced a boost to the GST rebate that, just like the Manitoba offer, will come as of July 1st. And this is, again, easing the GST on essential grocery items. So this is something similar to what the federal government has done already. We're waiting to see. We've got some colleagues up on the Hill this morning who will be asking federal officials what they think of this, whether there's more that the federal government could do to address affordability. Just yesterday, the finance minister was asked if, in light of rising gas prices, they would look at easing the gas tax. No commitment on that yet, though I think we should all be watching for that coming spring economic statement, essentially the refresh on the federal budget coming this spring, to get a sense of what potential affordability, small ticket, consumer-focused items the federal government could be looking at to continue addressing the issue of affordability.
Okay, that is CTV's Rachel Aiello joining us live. So interesting. Thanks, Rachel.
Anytime.
Now let's check in on some of the stocks on the move in early trading and also how equity markets are starting off the day. So we'll start with the TSX. It's been regaining a lot of points this week after a sharp drop last week. So we can see the TSX is up by more than a percentage point to start the morning. We'll keep a close eye on that. In the meantime, we're going to check out shares of Boralex. Some big news breaking this morning that Brookfield and Quebec pension fund, the Caisse de Depot, are teaming up to buy Boralex in a deal valued at $9 billion, including assumed debt. After the deal, Boralex will operate independently and plans to accelerate the execution of its 2030 strategic plan. And that transaction, that's expected to close by Q4. We're also watching Brookfield today. It's up by 1.6%. And of course, the Caisse is a private company, so we can't see that. But Brookfield, Boralex seem to be receiving some optimism from investors today. If we take a look at the U.S. markets, it seems as though investors are feeling a little more optimistic of news that potentially there could be some negotiations on the way between the U.S. and Iran, although it does depend on who you're listening to. The Nasdaq is up by more than a full percentage point. S&P 500 and Dow Jones also trading in the green today. So we'll keep watching that. Iran saying that that's not happening and there's no talks. The U.S. is saying there are talks. So we'll continue to bring you the latest from both sides, I guess. And if we take a look at some companies that we're also watching for today, ARM Holdings is higher after the semiconductor designer says it'll start selling its own chips for the first time. It's up by more than 14% at the moment. The new business is expected to generate about $15 billion annually within 5 years. We're watching the price of oil as well. It's paring gains after, as I mentioned, Iran says a ceasefire is not currently viable. So oil down for the first time in a while, down by more than 4%. And then we're also watching the price of gold. So gold has been extending gains over the last couple of days. It's up by more than 3%, over 4,500 at this moment. This comes despite Iran signaling little willingness to compromise, but investors seem to be dipping back into gold. And of course, that's probably why the TSX seems to be doing a bit better this week as well. And we'll check in on the loonie. It is dropping today as investors weigh the ongoing escalations and de-escalations in the Middle East, trying to keep up with what both sides are saying. The loonie is currently down. Coming up next, we'll take a look at some of today's notable calls, including 7 energy picks from Goldman Sachs. Stay with us. Let's take a look at some of the notable analyst calls and recommendations. We'll start with General Motors. It's up in pre-market trading. Wolfe Research analyst Emmanuel Rosner raised the recommendation on GM to outperform from peer perform, writing that investors may be underestimating several tailwinds, including a lower net tariff burden and further improved EV losses. The price target is set to $96. Goldman Sachs raised oil price forecasts and is picking 7 winners among energy stocks. On Sunday, the bank upgraded its oil price forecasts across the board, now expecting Brent crude to average about $80 per barrel across 2026 quarters. That's up from prior estimates of $75. The stocks that Goldman is recommending include Chevron and Cenovus. And we'll take a look at those. Chevron, Cenovus are currently trading down right now. Of course, the price of oil is down. It seems to be affecting some of these energy stocks. And National Bank financial analyst Maxim Sitchev cut the recommendation on AG Growth International to sector perform from outperform. AG Growth reported earnings that trailed and sales that topped estimates for the quarter on March 24th. And it's down right now by a whopping 38%. Okay, just ahead, how to position your portfolio during a great deal of uncertainty over the conflict in the Middle East. That's coming up next. Stay with us. Hi there. Welcome to the second hour of The Open. Let's take a look at some of the stories we're following for you in the BNN Bloomberg newsroom. Shares of Boralex are rallying after news that Brookfield and Quebec pension fund the Caisse de Depot are teaming up to buy the renewable energy firm. The deal is valued at $9 billion, including debt, and shareholders will receive just over $37 in cash per share. That represents an almost 32% premium. After the deal, Boralex will operate independently and plans to accelerate its 2030 strategic plan. Chorus Entertainment has received a court order to proceed with its previously announced recapitalization plan. The move is designed to strengthen the entertainment company's financial foundation and support its long-term business strategy. It includes reducing debt and other liabilities, decreasing annual cash interest payments, and maintaining access to its credit facility. Shares of ARM Holdings are seeing a surge. That's after the semiconductor company says it'll sell its own chips for the first time. The move is expected to generate about $25 billion US within 5 years. Meta will be the first major customer from the UK-based company. Until now, ARM's main business has been to license its technology to semiconductor makers. And we'll take a look at the TSX, up by more than a full percentage point today after seeing gains yesterday and gains on Monday as well, coming back from a really rough week last week. If we take a look at the U.S. markets, it's a similar story there. Investors seem to be buying back in after hearing that there is potential news of a ceasefire or at least some negotiations coming in the Middle East. The U.S. has sent Iran a 15-point plan to end the war in Iran. It calls for Tehran to dismantle main nuclear sites and fully open the Strait of Hormuz. Investors have been reacting positively, so let's get some perspective from Jimmy Lee, CEO of Wealth Consulting Group. It's great to have you join us. Thanks so much.
Great to see you. Thank you.
It's a confusing time for investors. What are you telling clients to do amid everything we're hearing from both sides?
It is a very confusing time. I mean, we definitely need this war to end and oil prices to come down, because it's really taken a lot of the wind going into the momentum that we had in 2026 in terms of the economy here in the U.S. But I'm reminding our clients and investors in general to think about last year. Think about in April the 10th, when the market bottomed after Liberation Day with tariffs and the unknown around what was going to happen because of tariffs, how the year ended. And so right now, I think investors are fairly resilient with all the concerns, even besides the war, private credit, AI, software stocks. The stock market in the U.S. S&P 500 was only down around 5% year to date before a little bit of a recovery today. And so I think investors, are looking to stay invested if they can. And there's also a lot of dry powder still out there that's looking to get invested. A lot of investors missed this bull market since the lows of 22. And I think some of them are using these declines to get money to work.
We're seeing markets rebounding a bit today, obviously, as we can see on our screen right now. Do you think they'll continue to rebound once the Strait of Hormuz actually does reopen, whenever that is?
I do. I think if the strait is fully opened up and we've got ships flowing in and out of there as normal, I think oil prices will go down significantly. I think that there could be some collateral damage, but overall, I think the concerns about oil staying high, especially right now, there's some Asian countries that are really starting to hurt economically because of it. I think a lot of those reliefs will go, would be a great relief. And I think that people will be optimistic about what will happen. And so I think the stock market then will rebound in general. I think investors will resume the broadening of the markets and invest into areas that show more value than maybe the heavy tech names that have led the market for the last 5 years. So I see small cap stocks doing well. We're positioned for cyclical sectors, actually. So we don't think that we're going to go into a recession of any kind, even though the risks have gone up a little bit.
By cyclical sectors, do you want to name a few? Like, what are some examples of that?
Yes, we really like industrials. We think industrials benefit from a lot of the onshoring, sentiment that we're going to continue to see as the bifurcation away from China is going to continue to happen. And I think that financials that have been beaten up so much already this year is another sector that we can look at. And also tech. I think you have to be an active investor in tech But I think there's some names that have really gone down too much because of the scare with AI and software. And so I think you have to be selective. So, maybe this is a time for active investing more than ever and recently. And we've been telling clients that if you just own the market, the S&P 500, you're heavily weighted into the big heavy tech names that are at the top. And so you're not as diversified as you think you are. And investors are generally underweighted in mid-cap, small-cap stocks here in the U.S. and overseas as well. I'm a little concerned more than the beginning of the year about overseas stocks, but I also think that some of the sell-off in some of those markets might be good investing opportunities too.
There's talk right now. I do want to talk a little bit more about that and overseas opportunities in a moment. But just staying with the U.S., there is some talk that the U.S. could be headed for a recession. Do you agree with that assessment?
Like I said, I think the risks have gone up a bit because of the higher oil prices and because of this war. But I really think that we're set up for good fundamentals to follow through this year. I think that we're going to have good earnings, and that's really what we need to count on, is that companies come through with good profits and growth as predicted going into the year. The higher oil prices, I think, takes a little bit of the momentum away from what we were hoping for with the tax cuts and a lot of people getting refunds in the next few months. We think that those checks will hopefully turn into optimism and change consumer sentiment a little bit. Not sure, though, if all that money that people are going to get is going to go towards paying off debt or being spent, which can help the economy grow. So we're hoping that this war can end soon, oil prices come down, and we resume the optimism that we had going into this year.
Okay, so let's go back to your thoughts on investing overseas. Are there certain areas and certain markets that you like? And you said there's some potential buying spots. Are there certain sectors as well?
We'd like to develop the emerging markets. Emerging markets are still up this year, and we think that the Asian countries can benefit. But like I said a little bit ago, some of those countries are being hurt by the higher oil prices and really a supply-demand issue over there. And so, we need to get the situation settled in the Middle East. I think geopolitically, though, which has been, geopolitics has been at the top of my list in terms of short-term economic or markets risks. I think that longer term, this chess game that the U.S. president has been playing is going to work out in the long run. I think that we need to have stabilization in the Middle East. I think those countries around Iran have now seen that it can get hostile for them too. And so I think they're going to rally around us in terms of the situation. I think overall, this is geopolitically, putting the U.S. in a much better situation against China. And when President Trump meets President Xi in China soon, I think that it gives the U.S. president a little more negotiating power with Taiwan. And so I think geopolitically, longer term, what's going on hopefully will end up positive for the world.
And just lastly, you were talking about small caps as well. There seems to be a lot more conversation this year around small caps. Do you still think that they're undervalued at this point?
I do, but we need rates to come down. Small cap stocks are very rate sensitive. And so, with the oil prices ticking higher, the inflation fears have gone up a lot. And so people are worried if the Fed's going to cut it all. And so we think that they need to. We think there's many reasons why the Fed should cut. I'm not as concerned about inflation as everybody is. Now, I'm not saying that prices haven't gone up and stayed up, but I think that we need, to be more concerned about jobs. We need to continue to grow this economy. And, lowering rates will get potentially the biggest asset that a lot of, people own, which is their homes, get that trading again and back into balance. And so if houses and housing gets better, supply and demand, there's more trading going on, people are selling and buying, that'll really help the economy in a lot of areas. And I think the optimism around lower rates is something that we need to get back, including for business.
Okay, we'll leave it there. Jimmy Lee, CEO of Wealth Consulting Group, appreciate your time today. Thanks for joining us.
Thank you.
Coming up, we've got an analysis of Canada's telecom sector and why our next guest says regulation in Canada is stunting competition. That's next. In 2030, Quebecers CRTC mandated access to the big three carriers' wireless networks expires. Until regulators decide whether that access will be extended, Canada's telecom sector is stuck in a period of uncertainty. Our next guest argues that Canada's market is fundamentally different from the U.S., where competition is driven by investment rather than regulation. Here to tell us more is Maher Yaghi, Managing Director, Telecom, Media and Infrastructure Analyst at Scotiabank. It's great to have you join us. Thanks so much.
Thank you for having me.
So these differences that you're highlighting between Canada's market and the U.S. market, how do these differences shape the competitive landscape in each country?
Yeah, great. So, having covered both the Canadian and the U.S. market, it's very clear that from our research that we have done, that to get a sustainable competitor to remain in place long-term, to affect and lower prices in the marketplace, it's better to see that competitor invest significantly in infrastructure to position themselves to compete in the long term instead of relying on regulation to provide them the network infrastructure to compete. I.e., in our view, for Canada to continue to see a competitive wireless market, we need to see significant investment by the challenger, which we have not seen so far to date.
How would you start to see investment, though? Like, what needs to happen for that to change?
Right now, regulation is definitely helping Quebecor, and Quebecor has played their hands perfectly, i.e., in terms of utilizing the regulatory environment to provide cheaper, plans in the marketplace. But to continue to rely on regulation, it means that you're sacrificing the investment opportunity that new technology will allow you to provide to consumers over the long term, because by through the regulation that the CRTC has put in place, the return on invested capital for the incumbents has been lowered significantly. You're basically socializing a little bit the network effect that these companies have invested in to provide support to a challenger. What that in the long term means, and we've seen that happen in Europe and other places where you have that kind of regulation, is that the incumbents reduce their investments because they need to protect their free cash flow, and hence long term the technology and the network starts to deteriorate. We argue in our report that for the incumbents like Bell, Telus, and Rogers, right now they're being handicapped by investors. Their stock performance has been quite negative compared to the S&P, the TSX. And in our view, their best approach going forward is to really significantly cut their capex, because they're not going to get the return on those investments like they did in the past. So eventually the CRTC, I think they're going to come to a crossroad. They're going to have to decide either they need to continue to provide this subsidy to the challenger long term and suffer the consequence of deteriorating networks, or basically stop the regulation as it was intended to be stopped in 2030 and let Quebecor compete on their own.
Okay, so I want to go back to something you said just a moment ago, is that you think the incumbents should be cutting wireless capex. How would that boost like BCE, Rogers, Telus stock moving forward? And also, what impact would that have on the country's productivity as a whole?
Yeah, so these companies, when you look at valuations for telco stocks, they trade on free cash flow. Free cash flow is really the biggest determinant of success for a stock. And growth in free cash flow is the most important metric. These companies, in our view, by cutting their capex to levels that we see both in the US and other places in the world, could provide them with upside in the 10 to 15%, from a valuation perspective. Now, obviously, productivity for the country will not be helped by that. However, these companies, they have high leverage ratios right now. All three of them, TELUS, Bell, and Rogers. So they would do themselves a favor, in our view, and see their stock performance improve if they were to cut their capex, like we're suggesting in the report.
Okay, so we've talked about the incumbents. Now let's talk a little bit more about Quebecor, because some investors, you say, are treating Quebecor as Canada's version of T-Mobile. Why do you think that comparison kind of misses the mark?
This is a flawed comparison in our view. It's wishful thinking. We provide the background in our analysis to show that T-Mobile became the T-Mobile that it is. And if you want, we can maybe talk a little bit about T-Mobile. T-Mobile has really changed the behavior of Verizon and AT&T in the U.S. by investing significantly in network infrastructure. And now T-Mobile has one of the best network, if not the best network in 5G in the US. This is completely the opposite for Canada. When you look at CapEx intensity by Quebecor, it's one of the lowest in North America. Second of all, if you look at market share for T-Mobile, when they bought Sprint in 2020, they had about 20% market share. That went up to about 33% market share after the acquisition. In the case of Quebecor, you're running at right now 12, 13%. They're adding only 0.5% per year in market share. It will take them terribly long time to catch up to where T-Mobile was in 2020 and to position themselves as a real challenger long term. But our view is that to really become a significant challenger like T-Mobile, they have to invest more, which, I think it's easily argued that they have not so far.
And just lastly, how much of Quebecor's valuation depends on the CRTC extending this contract beyond 2030?
Right. So right now, Quebecor stock is trading at 8 times EBITDA, for example, in the same environment, same level of multiple that T-Mobile is trading at. T-Mobile is growing more than twice as fast as Quebecor. However, when you compare Quebecor to the other incumbents in Canada, they're trading at a point or even 2 points premium to the incumbents. All that premium, in my view, is related to this regulatory support that is coming from the CRTC. So if that regulatory support goes away in 2030, we expect multiples to contract or to converge to where the other incumbents are trading at.
Okay, we'll leave it there. That was Maher Yaghi, Managing Director of Telecom, Media and Infrastructure Analyst at Scotiabank. Appreciate your time and your insight on this. Thanks so much.
Thank you for having me.
Coming up, how many Canadian companies hold formal intellectual property, and how does this compare to other countries? That's after the break. In 2022, fewer than 1 in 4 Canadian businesses had any registered intellectual property, with trademarks making up most of the protected assets. Our next guest says this pattern suggests most Canadian firms either don't generate IP or aren't systemically protecting them. So here to tell us more is Kaylee Thiessen, Chief Economist at the Canadian Shield Institute. It's great to have you join us. Thanks so much.
Thanks for having me, Lindsay.
So currently, I wonder if you can tell us how many businesses in Canada actually have registered intellectual property.
Yeah, well, the short answer is 21%. And this information comes from a survey that was done in 2022. It was of businesses that have at least 20 employees. So we're not talking about smaller companies. We're not talking about sort of micro enterprises. What we're looking at is businesses with at least 20 employees, at least $250,000 in revenue. So larger companies we found, or Statistics Canada found through their innovation and business strategy survey, that only 21% of those companies are protecting their assets. That includes trademarks, it includes patents, it includes trade secrets, which I'm learning a lot about in the next little while. And one thing that I've been really interested to learn is that I can't tell you if that is good or bad, or if it's sort of holding steady. There is a survey out in the field right now, so we'll be able to compare this year's results to 2022 results when the new data comes out. But at the moment, I can't say, are we improving, are we declining, are we holding steady?
Interesting. Is that usually the measure in terms of how many businesses actually have registered intellectual property? Because I know you mentioned the number of employees a business has. Is that the main factor?
Yeah, well, this is just the survey that Statistics Canada put in place, and they put it in place in that way to avoid sort of overburden of smaller firms. That doesn't mean smaller firms don't own IP. It just means that the survey didn't collect that data. And I think a lot of times there are a lot of creators who probably have assets that aren't protected, and then they end up being copied, particularly thinking about the fashion industry as an example.
Why the fashion industry?
I just hear a lot of stories from friends and other collaborators who work in that industry. They design products, put them up on Etsy or other sites, and then often we'll see their designs copied.
Got it. Okay, so I want to go back to that then, because I take your point that at this point we don't know whether the percentage of businesses that have IP, whether that's a good percentage or a bad percentage, but how important is intellectual property for a Canadian business?
Yeah, well, at this point, the businesses that we're looking at, so the size that the survey looked at, most of those companies are tech companies of some form or another. Either they are buying technology in order to streamline their business practices, or they're producing technology in hopes to streamline their business practices or sell that to someone else. If you're selling that business practice, then you need to protect it. You need to patent it. You need to protect it from actually being copied and commercialized by someone else, even after all of the hard work that you've done. And we really view this as a economic development issue for Canada, to think about making sure we are turning the innovations and inventions that are created through all of the great research and development investments that we make in our universities and our companies through tax credits. We wanted to make sure that we're converting that into IP that's owned in Canada and then producing the economic spillovers and economic benefits here.
So are you saying there is something the federal government could be doing to help these businesses, or is this really on the businesses themselves to get an IP?
Yeah, we are seeing it as a partnership. So there are companies that are producing IP. They need to learn and be sort of mentored through the process of what it looks like to register that IP, create that IP, secure it, lock it down, looking around the world, protecting that IP and asserting their sort of ownership rights over that, as well as making sure the government is providing support. So providing that educational piece, providing the institution that kind of moves forward, protecting and asserting the rights of IP around the rights of the IP of Canadian companies around the world.
So you've mentioned a couple different types of IP, I guess, that businesses could have: trademarks, patents, trade secrets. What's the difference between them? Is one better than the other?
Yeah, well, they do different things. So a trademark is protection over an identifiable piece of your brand. So you could think of the Lululemon symbol, or what's another good one? The Hudson Bay stripes. Those are trademarked. Well, they're trademarks. And then the other piece of that would be like a name like Shopify, for example, would be trademarked. If you look at patents, that's a novel invention, something that's new, or a new piece that has been built on a previous invention. And there you want to protect that, lock it down so that it's a piece that you can license. It's an activity that you can license to someone else, or is protected that only you can use it. And then the third one there is trade secrets. And those are like recipes. The one that comes to mind for me is Mott's Clamato, which is a great Canadian product, and one that is run by a trade secret. So we don't know what the recipe is. There are a few people in the company, of course, that do, and they are not able to talk about the recipe or give it away, and that's like done through non-disclosure agreements and those sorts of things. Those are three different kinds of IP.
Interesting. Okay, so now that we know the percentage of Canadian businesses that actually have one of those three, how does this IP profile impact Canada's global competitiveness?
Yeah, well, if we look around the world, I would love to be able to say I can just compare the survey results from that Canadian survey to other countries. We actually haven't found data. I'm sure that it exists. I just don't know where it is. So anybody who knows, please let me know. But also looking at, there is a lot of data that we can compare across different types of IP, and we find that Canada is very slow and we're running behind. So in 1990, we produced about 100 patents per million people in Canada, and that was the same in 2024, where many other countries in Europe and in Asia actually increased their IP per million of the population to as much as 600. So that difference between 100 and 600 is some of how we're lagging. Why is that important? So Canada ranks number 3 in the world in terms of sort of the complexity of our research and innovation ecosystem. So there's no doubt that we are creating inventions all the time. Where are they getting commercialized? That's the piece that we're missing, because we rank 35th in economic complexity of the types of products that we actually produce in Canada and then sell overseas. And we want to see the ranking, that 35th ranking, move up closer to where our research and development ranking sits.
So interesting. Okay, we'll have to leave it there, though. We're out of time. Kaylee Thiessen, Chief Economist at the Canadian Shield Institute. Appreciate your time. Thanks so much.
Thanks for having me.
Coming up, we will find out just how generous Canadians are when we speak with one of Time's most influential people of 2025, who just happens to be the CEO of GoFundMe. That conversation is coming up next. Stay with us. Shares of Boralex are rallying today after news that Brookfield and Quebec pension fund the Caisse de Depot are teaming up to buy the renewable energy firm. The deal is valued at $9 billion, including debt, and shareholders will receive just over $37 in cash per share. That represents an almost 32% premium. After the deal, Boralex will operate independently and plans to accelerate its strategic plan. Shares of AG Growth International are plunging today. The company posted a steep decline in profit in its latest quarter, cut its leadership team in half, and also suspended its dividend. Some analysts note the results might cripple the company's growth after a turbulent 2025. AG has been grappling with accounting issues around its Brazilian operations. And OpenAI plans to discontinue its Sora AI video generator. The company is also winding down its partnership with Disney, which was centered on the app. Disney had previously agreed to license its iconic characters to OpenAI for use on Sora and take a $1 billion U.S. stake in that startup. The move to shutter Sora coincides with a push by OpenAI to streamline its product lineup. And we're watching North American stocks today. It seems as though investors are optimistic after hearing some news out of the Middle East that potentially we could be coming to an end to this war in Iran. The TSX in particular is up by more than 1%. Same with the NASDAQ, and we're continuing to track that today after some heavy losses for the TSX last week. So just how generous are Canadians? According to GoFundMe, in the last 5 years alone, more than $1 billion Canadian has been raised through the platform to support Canadian causes. Joining me now in studio is Tim Gadugan. He's the CEO of GoFundMe, and he's also one of Time's most influential people of 2025. Congratulations.
Thank you very much. It's great to be here.
Thanks for joining us in studio.
Great to celebrate Canadian generosity. It's amazing to see what's happening.
Yeah, I mean, those are some pretty interesting numbers. GoFundMe has now been in service since 2010, which is crazy to think about because you hear about it so much. So many people use that platform. Can you remind us how it all started?
Yeah, it started with our two co-founders thinking, wouldn't it be great for people to help each other in all kinds of different ways? And originally they anticipated it being people, getting their friends to help them go on a trip or maybe get married. And it turned into something much more very quickly, where people have started helping each other for all kinds of things in all aspects of their lives. And we started here in 2013. It was our first international market, and Canadians have adopted. I think we've up to nearly 20% of Canadians have used GoFundMe, which is pretty incredible.
Canada was your first international market.
Yes, it was 2013.
Why?
It was a natural, it's right next door.
Yeah.
There's some real similarities in the way people interact.
Yeah.
It made a lot of sense, and it's been a really, really important country for us ever since.
Do you know since then how much money has been raised overall?
I think it's approaching $2 billion, but it has accelerated over the last 5 years. So as you mentioned, $1 billion just in the last 5 years. To give you a sense of that, that's a big number. It's hard to relate to.
Yeah, it's hard to wrap your head around.
Over 6,000 times a day, Canadians are supporting each other on GoFundMe. 6,000 times a day.
I don't know if you have the numbers, but like just in comparison to other countries, does that show just how generous Canadians are?
Canada's really up there. It's a top 5 country. We're in 20 countries around the world, and so really up there in terms of supporting each other.
And as you say, like GoFundMe is used, people use it for so many different ways to raise money for different things. Where is GoFundMe seeing the fastest growth? Like personal causes, community needs, or larger institutional fundraising? Is there one that
So we're still mainly seeing individual fundraisers. So a couple of categories that have actually grown pretty quickly is people fundraising for their own business. So I was just with a customer yesterday, Mabel's Fables. It's a beloved bookstore here in Toronto, needed to move, had some extra expenses, raised $130,000 and made that move a lot easier for them. So it can be individuals for their own situation, it can be for the business they operate, or it can be for community projects. So it really crosses the gamut. It's pretty amazing to see what people are doing.
Yeah. Is there some ways that the company is kind of trying to evolve, maybe new partnerships, or how has GoFundMe evolved even since it began?
Yeah, I mean, the principal thing that we do is we try and make it easier for people to ask for help. So we've introduced a lot of technology. In fact, just last week, we introduced a new AI-powered coach so that every single person who's thinking about starting a GoFundMe can have help crafting their fundraiser, setting their goal, managing their goal, sharing all of the steps you need, because fundraising is an unfamiliar thing for most people starting a GoFundMe. Many of them have never done a fundraiser before, and there's actually a lot of things you need to do to make it successful. So kind of holding their hand with all of the experience that we've gathered, because we've had over 40 billion US raised since we've been running the platform.
Wow.
So taking that experience and giving it to people in a scalable way.
And as you say, like some people just find it difficult to ask for help, right? Most people do.
We all do, is the reality. I mean, everywhere I've gone in the world, everyone I've spoken to is like, it was hard for me to do this, but once I did it, to see that help flowing in was so powerful. And it's not just the money. The money is super helpful, but it's the psychological and emotional support from friends, family, community that really lifts people up in a very powerful way.
There's so much talk these days of different companies starting to integrate AI into how they operate. How is GoFundMe integrating AI into?
Yeah, so we started at the feature level. So for example, people find it hard to decide, should I ask for $1,000, $2,000, $3,000? So as they wrote their fundraiser, they could opt into our SMART goal technology, which says, hey, based on what you're fundraising for, here's the goal, and here's how to manage it, because you can change the goal over time. So that and other features have already been used 80 million times around the world. And then we integrated that, as I mentioned, a couple of weeks ago, into a more holistic coach that holds your hand through the whole journey. But the interesting thing about AI is there is also a lot of concern about AI. Is it going to sort of replace us? And the interesting thing about what we do is helping one another is inherently human. That's not substitutable. But the process of doing that, we can help a lot with technology. So making an ever more powerful tool that allows people to understand the steps they need to take and make it a little bit easier. That's what we're doing. And it's working incredibly well.
And maybe a way to, because obviously there's so much good that comes out of GoFundMe, but there also has been some fraudulent accounts, some bad actors that are using the site. Is there more ways that you can help crack down on that?
Yes. So for us, earning people's trust every day is so important because people are putting often what is the most important story of their life on the platform. And people are also putting their hard-earned money as donors. So we spend a lot of time thinking about, and again, using technology and all the knowledge we have gathered to spot anomalous fundraisers that don't look quite right. We investigate all of those. We investigate every single report we get from a user that says, I've seen this, it doesn't look right to me. And if there's a problem, we take them down. If they have raised any money, we refund. In fact, we have a global giving guarantee, which means that any donation of any amount anywhere in the world is covered. So if you have a problem, we've got you covered. So that allows people, as I mentioned, 6,000 people a day, you can donate with the complete confidence that your money is protected should there be a problem. Fortunately, it's extremely rare. But we are dealing with humans, and not everyone is always doing things properly.
It's good to know when you're donating, you're actually donating
you're
to the
protected,
cause.
like completely covered.
It must be interesting, too, to see trends of how generous people are and when. Like I think about, like food banks, for example, can see trends of when people are able to give more and give more back to their community and when they can't. And I wonder if you see the same trends.
Well, we see an interesting thing is that when a period of need goes up, the readiness of other people to help those in need goes up. Probably the best example is the pandemic.
Yeah.
As I mentioned, I started at GoFundMe the month the pandemic happened.
Good time to start.
Well, so, a lot of good, challenging, like a lot going on, but immense need, but also immense desire to help. And so we see both. So, in moments of crisis, there are people affected by the crisis, and there are others who are like, I want to help. I want to step up right now. So we see that again and again.
So interesting. So much to talk about, but we are out of time. Tim Cadogan, the CEO of GoFundMe, appreciate you coming in studio. Thanks for joining us.
Thank you. Appreciate it.
And coming up, we've got hot picks after this. We will zero in on 3 event-driven equities to keep your eye on. That's coming up next. Stay with us. Welcome back. It's time now for Hot Picks, and today we are zeroing in on 3 event-driven equities. These are stocks facing unique catalysts that could unlock meaningful upside. Our next guest has Cross Country Healthcare as his top pick for its potential long-term tech-enabled transformation. So let's get more perspective now from Mike Piccolo, SVP in Equity, Senior Vice President in Equity Research at Wedbush. It's good to have you join us. Thank you.
Great to have be on the show as well. Thank you for having me.
So let's get to that first pick of yours, Cross Country Healthcare. Why do you think there's maybe so much upside within this company?
Yeah, so great question. And it starts with the thematic report that I actually published when I initiated coverage on the company, which was with a neutral at the time. But we, as event-driven analysts, are looking for dislocations in the market that are caused by a change in shareholder base. So what drove me to look at Cross Country Healthcare was, as you see the chart indicates, it had a failed merger with Aya Healthcare, one of its competitors last year, that was at about $18 and change per share. The deal didn't close due to FTC regulatory concerns that pushed it past the merger drop dead date, and both companies decided not to go forward with the merger due to the FTC scrutiny. But that said, their revenue had fallen off from pandemic highs. If you look back at the company's historical financials, they had a big boom during the pandemic because what they do is nurse and healthcare staffing for hospitals and third-party clinics and whatnot. And they recently expanded into premium sectors such as home care and senior housing. So what drives my pick here is that I think there's a change of shareholder base that occurred post the merger, people that have seen the declining financial performance, but with the return of their co-founder, Kevin Clark, as CEO, because they did get rid of the current CEO when the merger failed, and his background in creating technology companies, I think this company is given its labor-intensive business model, going to harness the AI revolution that we talk about as a firm, and is going to implement this technology to not only improve internal operations, efficiency, and profitability margins, but also increase the amount of services they can provide to their customers with the tech platforms they already offer.
Next up is TaskUs Incorporated. This one's interesting because you say failed take private creates potential opportunity for this company. Is that right?
Yeah, similar thesis to Cross Country, but this merger failed not due to FTC or regulatory issues, but because of shareholder support. So what's notable is Blackstone owns all the Class B shares along with management that have voting power. So the reason this deal failed was it was unable to get the majority of minority condition as shareholder approval. And you had vocal shareholders such as Think Investments come out with targets as high as $25 per share, which was above the $18.50 raised acquisition price at the time. And as you see in the chart that you're showing there was even a point of time that merger arbitrageurs speculated there would be a higher bid when it traded above the $18.50 per share offer. But since the deal collapsed, the stock has come down. It is also faced with AI headwinds, given its labor-intensive industry. So what they do is they're essentially almost like a BPO provider, providing outsourced functions for technology companies specifically. They have 3 segments: digital customer experience, content and safety moderation within trust and safety, and then a growing AI services segment. What I think the market is misunderstanding here is that it is not going to be cannibalized by AI, but enhanced, evidenced by superior growth that the AI services segment has had over the past couple quarters. So I think they're at the beginning of, again, the AI revolution that's going to benefit this company. It trades at a very depressed earnings multiple, both to its historical trading patterns and also compared to its peers. However, one thing I would note is they declared a special dividend that goes X tomorrow. So there's likely to be weakness in the stock. So if I was considering this idea, while we do have an outperform and a $14 price target, for the next 12 months, tomorrow may provide an attractive entry point because we'd expect the stock to trade down by roughly the amount of the special dividend, which is $3.65.
Interesting. You mentioned those AI headwinds in relation to the labor force, and I was going to ask about headwinds or any other risks. Can you kind of explain that further, and also if there are any other risks maybe for this company?
Totally. There are risks, and I would say it really hinges more on execution and just the implementation of these AI initiatives. Because, for example, one of their largest customers, they have a high customer concentration that's supposedly a large multi-cap social media company that accounts for, 27% of revenues of the last quarter. And with these big hyperscalers and social media companies deploying resources and CapEx into AI, that does create a potential headwind and risk for the company should they decide to insource some of these services that currently TaskUs provides. So while there are certainly risks to this story, I think the valuation is what makes it attractive to me. In terms of how I publish my research, I do probability weighted price targets between a bear case, a base case, and a bull case. And in my bear case, I have an $8 price target that's supported by a discounted cash flow valuation should there be some pressure on those segments. And that's what supports my bull case multiples and how I arrive at a probability weighted $14 price per share. I try to account for some of those risks in my different valuation scenario analysis.
Okay, got it. All right, so let's move on to your last pick for today, and that is Burford Capital.
Yeah, so this is a binary outcome type situation. So long story short, this is one of the largest litigation finance lenders. What they do is they provide third-party funds to corporations, law firms, anyone that's engaging in litigation. And essentially what they try to do is they manage the caseload with a proprietary data set software and then lawyers on staff to try to predict potential settlement outcomes, win rates or loss rates, and they have got a great track record of doing so since inception with a cumulative 87% ROIC and a 26% IRR. So this is really just a bet on the management team and the business model while the stock's trading at or near all-time lows. And what the event is and the catalyst that could surface that value is they've had a litigation claim with Argentina's YPF, which is their energy company that was nationalized in recent years. And long story short, there was a summary judgment that awarded them $13.1 billion, excluding accrued interest and claims, which they're entitled to a large percentage of those proceeds. They've outlaid about $200 million so far of deployed cost for this case. So should they actually get the full $7 billion plus accrued interest, which we don't think that's likely, we think a settlement is more likely, but even half of that amount, which is what I use to calculate my price target, would result in a share price in the high teen range of like $18 to $20 per share. We have a $13 price target, though, also accounting for the timing and the risk of them not receiving that settlement. But again, compared to where the stock trades today, I see asymmetric potential upside. Downside is relative, maybe $1 or so to the upside in the $5 to $10 range, depending on the YPF outcome.
All right, we're going to have to leave it there. We're out of time. Mike Piccolos, SVP in Equity Research at Wedbush. Appreciate your time. Thanks so much.
Great. Thank you again for having me.
Thanks. Coming up, PIMCO Tiffany Weil is warning that the shock from rising energy prices is still going to hit the economy. More on that coming up. PIMCO economist Tiffany Wielding is warning of the inflationary shock from rising energy prices and says it will reduce real incomes around the world and hit global growth rates. Take a listen.
The market's first and primary focus here is on the implications of inflation, of higher energy prices. So as a result of that, you've seen front-end interest rate markets, reprice quite a bit, with the ECB path and the Bank of England path being the most notable here, which are now pricing in hikes as a result of this. Ultimately, that I think makes sense that the markets would react this way. But you think we have to play this out a little bit more. before. This is not only a large price spike for energy, but this will be stagflationary in the sense that it will reduce real incomes around the world, and ultimately that will weigh on growth. So the longer that this goes on, we think that the longer the price spikes are elevated, the more growth effects that you could have, and ultimately we think that central banks will eventually need to focus on shift their focus from inflation, to more of these downside growth effects. And we think ultimately the bond market, when that happens, is going to be a great diversification asset in order to do that.
Well, you wrote that, this is an opportunity to invest against the prevailing narrative. And I wonder what that is. I mean, if you're entering into an environment where maybe the Fed and other central banks are going to be more dovish than currently priced, but also you add stagflationary elements into the mix. I mean, how does that translate into a portfolio, if you will?
Yeah, well, I mean, if we take a broader step back, we came into this year with resilient growth across the world. But if you looked under the surface, there was incredible divergence. And the reason why we had that divergence is because we've had tariff-related shocks that have impacted global growth unevenly. And against that, we're seeing AI investment that really accelerated. So that divergence under the surface, suggested that there was more fragility than the resilience. Headline resilience would have suggested, but ultimately, this energy shock creates even more divergence as a result. So you're layering on top of uncertainty here, and the bond market, again, relative to equities and credit, when you have uncertain environments, should be a diversification asset and should start to garner a premium for that diversification benefit.
I am curious, though, Tiffany, about why we haven't seen a little bit more movement in some of the break-even measures, the idea of what inflation expectations are longer term. Is the sense here that whatever increase that we might see in inflation, that will be relatively short-lived, and that's maybe why it's not showing up?
Yeah, I mean, so it depends on where you look on the break-even curve. So, 1 year in, break-evens and inflation swaps have really priced higher as a result of this. But you don't see that if you look at longer-term inflation expectations. In the U.S. market, if you look at five-year break-evens, they're actually down a little bit. So ultimately, we think this speaks to the broader points that we're making, which is this should be a relatively short-lived shock, and ultimately, to the extent that it weighs on growth, weighs on the labor markets, that will reduce so-called second round effects, and ultimately that will keep longer-term inflation expectations anchored.
Is there any concern about the idea that we are going to see maybe a little bit more economic pain in Europe, certainly in Asia, as a result of that? And would that have any reverberations on us here, the world's largest economy, or are we sort of, to a certain extent, walled off from that?
Well, so the U.S. has shifted its energy production status over time. So we used to be an energy importer. Now we're a net exporter. So that does buffer the United States from some of this. But nevertheless, global supply chains are very global. And what happens in Asia, for example, doesn't just stay in Asia. And the bottom line for that is that we think petrochemicals and other energy from the Gulf is really powering Asian manufacturing. And so a more prolonged disruption in energy does have the potential to reverberate through global supply chains, and have some more disruption in Asia. That will spill over into the United States as well as elsewhere. Europe obviously is also very impacted by this. Global gas LNG prices are up quite a bit as well. And Europe does source a lot of that from the Middle East.
Know Your Options is back. Tune in today at 3 p.m. Eastern to have all of your options trading questions answered by Chris Tom of Moat Financial. You can send us your questions at knowyouroptions@bnnbloomberg.ca. And that wraps up this edition of The Open. Morning Markets is up next with Roger Peterson.